Hey, what's up, everybody, and welcome to SBE Ally. My name is Dan. This is a space where small business owners can come and get the advice and support they need to get their businesses on the road to success. If you like the content on this channel, please subscribe to it and click the like button. Today, we're going to be talking about working capital. So, there are two types of capital to consider when you start a small business or at the conception stages of a small business. And that's startup capital and working capital. Today we're going to talk about working capital, but just for reference purposes, I'm going to define what startup capital is and give you a couple examples of that as well. Startup capital is the initial money you invest in the business. And usually it's cash, a loan, or an investment fund from an investor or a friend or family. And that's usually used to purchase software, make investments in a website, purchase any equipment, put down security deposits on any physical space that you need, and also seeding a bank account with a little bit of cash or working capital. And that's how we're going to segue into working capital. So what is working capital exactly? Think of working capital as the lifeblood of your business. It's what you need to get through the day-to-day operations, month-to-month, week-to-week, and month-to-month operations within your business. So I'm going to put here up on the screen the financial definition of what working capital is. And basically what working capital is your current assets minus your current liabilities. So your current assets are anything that is basically liquid to your business or going to be converted into a cash within a short period of time, generally less than a year. And that is your cash on hand and possibly the depth of a line of credit if you have it, and any accounts receivable you have coming in that's due to the business anytime soon. Current liabilities would be on the flip side. It would be any vendor payments that you owe or any payments that you would owe to vendors, payments to employees, taxes due, any rent payments due within the next month or so. So there, as we said before, there are two basic sources of working capital with respect to a small business, and that's going to be cash and a business line of credit. And cash, of course, everybody knows what cash is. But a business line of credit, usually whenever a small business owner starts up and they don't have a lot of cash on hand, they could go to the bank and get a business line of credit. Some people do use a credit card for this. I don't recommend you use a credit card just because the interest rates are very high on any cash advances of a credit card. I would recommend that you apply for and you get a business line of credit with a bank and a manageable interest rate. Typically, lines of credit are going now for 4 and 5%. So, how do you calculate working capital? So we're gonna talk about ways, some very general heuristics of how you can calculate how much working capital you'll need for your business. So here's what I want you to do. For instance, in this example, we're going to take and we're going to project the following over the next 30 days. If you have employees, or whether you don't have employees, I want you to consider yourself in this equation, especially if this is not a side hustle and this is something that you're feeding your family with. I want you to consider all the above on a payroll or all the above in this calculation, and that's your payroll projections. All right, so not only are you going to talk about or you're going to consider the hourly rates or salaries that you pay your employees, you're also going to look at any type of tax matches, tax payments. You're going to consider labor burdens such as unemployment compensation, workers' compensation, and whatnot. So you have to take all this into consideration. Don't just take what you're going to pay the employees and the raw number there. You're going to have what's called a labor burden or a percentage on top of that. So for instance, say, just to make the math easy, you project your payroll expense for the week to be $1,000. I would increase that by 30% to account for all the other taxes and whatnot that are going to come on top of that. And I'll talk about that in detail in another video about payroll requirements and the whole bag of hammers you get into with having employees. Second one you want to calculate out over the next 30 days is look at your rent, any insurance payments or utility payments. This is great if you don't have a physical space, so you can kind of ignore this one. But if you have an office space or you're using an office space at home, you might want to consider something in this budgetary line as well. Next one you want to look at is if you have any type of investments in any equipment, or you took out a loan to get the business started, you're going to have monthly long-term debt payments that are going to need to be paid as well. So let's say you have a payment on a vehicle that you purchased for the business, and that payment's $500. You need to take that into consideration as well. The next one, and I don't want you to overlook this or think that you don't need it, but the next thing you're going to have to look at is a marketing or advertising budget. Even if it's for just your website or any type of social media, budget something for that. Figure out the minimum you would need and use something to calculate it. Use your time. Assign an hourly value to your time, an hourly rate to your time. And if you spend 10 hours a week and you're paying yourself $20 an hour, assign $200 per week times the 4 weeks. Assign $800 to this number. Next thing I want you to look at is any inventory that you would need, any material purchases, or any accounts payable that you would have due within the month. And the last thing, after you crunch all this together, I want you to have a safety factor or cushion. Usually a good rule of thumb is 10 to 15%. I would recommend a minimum of 10%, but if you want to have a healthy cushion, I would recommend that you have at least 15% on top of that. So let's talk a little bit about how you would estimate this. So in this example, using these 5 guidelines here, or these 6 guidelines that I've laid out, let's say that you want to do a payroll projection. As we said earlier, you have 2 full-time employees, and they make $25 per hour each, and they're expected to work full-time during the next month. And let's say you pay yourself $5,000 in the same month. And yes, as I said before, consider yourself, especially if this is not a side hustle and you're living off the business. So estimate it this way: $25 an hour times 40 hours times 4 weeks times 2 people, and that's equal to $8,000. Add your $5,000 in. And then take that $13,000, and I want you to multiply that by 1.3 for all of the payroll burden things that we had spoken about earlier. You want to talk specifically about, you're going to have payroll tax contributions on definitely the federal level and possibly the state level, depending on the state that you're living in. You're going to have workers' comp premiums, and you're going to have unemployment comp premiums. And if you haven't considered that in your insurance calculation, you definitely need to put it here. I would recommend you put it in the payroll, because a lot of unemployment compensation, in fact, all unemployment and workers' comp premiums are based on the amount of payroll that you have in a given period of time. And yes, you got to pay these things for yourself as well. Even if you may be self-employed, in most states, you have to pay these premiums to unemployment and to workers' comp for yourself as well. Some states allow you to exempt workers' comp, some don't, but all of them virtually are going to make you pay unemployment insurance. If you have a retirement plan or health benefits for your employees, I recommend that your safety factor be 1 point, or your payroll multiplier would be 1.4 and 1.3. In this example, let's say you have all the above. So your 30-day payroll costs are going to be, they're going to be $18,200. I had this pre-calculated. I just wanted to check my math. So then moving on to the second one, let's say that your rent for a particular office space is $1,500, and your utilities are another $500. And your insurance premium for the month for your general liability or your errors and omissions insurance, or whatever any other type of insurance premium you have, include auto insurance, especially for a company-owned vehicle in this as well. And let's say that's another $500. So you're going to add $2,500 to that number, to the previous number that you calculated. Moving on, long-term debt payments. Let's say you do have a vehicle payment for $400, and you also have a bank loan for $1,000 whenever you started up the company. So let's add another $1,400 to that. You project $1,000 a month on advertising costs and promotional costs. And remember what I said, even if you're doing all of this yourself, please put something in this line, or get used to putting something in this line. Because as your company grows and begins to scale, you're going to be able to need something that you're going to have to be able to put in this line. And you're going to need something in this line as the company grows. And finally, let's say that we need $8,500 worth of raw materials or inventory, or money that we need to pay vendors for existing bills the month before. So you add all these up, and you're going to get just shy of $25,000. You're going to get $24,600 in operating expenses for the next month or the next 30 days. Multiplying that by your 15% safety factor, you're going to calculate $36,340 to operate your business within the next 30 days. So by using this method, the example that we're looking at here is going to need at least, as we said, $36,340 of cash or equivalent, or a combination of cash and line of credit to operate. If you are using the line of credit, please account for the amount of interest you're going to be spending as well, because a lot of lines of credit are interest only, so you need to account for that as well. So if, let's say, you put half this on the line of credit and the interest payment for the month is an additional $300 for you to use that capital, that's the cost of the capital, you need to account for that as well. So after we calculate that, the next thing we want to look at is we want to project the revenue that's going to come into the business within the next 30 days. So here's a general rule of thumb. If you have a business, such as a retail business or a restaurant, and you have frequent daily inflows of sales, so in other words, you have a lot of cash paying customers on a daily basis, you have credit card paying customers on a daily basis, I want you to have at least 60 days of working capital in this equation available to you or in your bank account. Yes, I know that sounds like a lot, but your business can suffer greatly if you don't have a minimum of this working capital, because there's a lot of unpredictable things that can happen in this month. You know, you can have anything from market swings, crazy stuff like natural disasters, fire, theft, supply chain issues, and volatility in the cost of goods sold, such as materials or even wages. You know, so this particular example, 60 days worth of working capital is going to be a whopping $72,680. And I need you to have that available in the combination of cash or a bank line of credit. And as I said before, if you have a line of credit, you need to account for that interest payment as well, or the cost of that interest payment as well. So what if you don't have a business that has daily inflows of cash or daily credit card or cash sales? Let's say you have a net 30 style business where you extend a lot of credit out to your customers and your customers receive the product or service, or you have to complete the product or service, or you have to complete the service, such as a construction business, and you get paid after you do this. So here's what I want you to do. I want you to extend that 60 days worth of working capital calculation. I want you to extend it out to 90 days, because I don't want to see your business suffer from lack of working capital, because then you're going to start playing the game of robbing Peter to pay Paul, borrowing more money, and you're going to be looking for money, and this is going to set you back even further, and it's going to hurt you even further. So just to summarize that, always make sure that you have 2 months of working capital. First, back up 1 second. First, I want you to calculate, using the 6 rules that I laid out, calculate the amount of working capital that you're going to need. And then take that working capital for a month, multiply it by 2 if you have a cash or credit card business that has inflows every day. I want you to multiply it by 3 if you have a net 30 or you have a cash lagging business from payments from vendors. And these types of rules are going to keep your business healthy. They're going to keep your business up and running, and they're going to prevent any types of, they're going to significantly reduce the risk of any type of setbacks that you can experience. So with that being said, if there's any way we can help, come check us out at www.sbeally. If you would like some help with this, help is available. Come to our website again, www.sbeally.com, and book a call with us. It's a 15-minute free consultation call. You'll talk directly to me. I'll see if there's anything I can do to help your business. We'll chat a little bit. If there's something we can do to help, there's many different options that we can explore. Come check us out. And I look forward to seeing you in my next video.